Hi, everybody. Welcome to the 7 and 7 show. I'm your host, Zach Ellison. And today I have with me one of my favorite people from the RIA space and one of the best wealth advisors out there, Paul Squarcia, who is the founder of One Charles, which is based just outside of my hometown of Boston. And I'm excited to have Paul on today because we share a lot of similar thoughts on the industry and similar DNA in terms of how we look at the investing universe and how we think about treating clients. So it's a real privilege to have you on, Paul, today. Thank you for joining.
Well, thank you for having me.
So before we get into the 7 investing questions, I just wanted to give everybody some background on yourself. So if you could just let us know how you got here and how you became a wealth advisor, I think that'd be really helpful.
All right, thanks. I started back in the industry in 2000 with Merrill Lynch, so coming up on about 24 years in the business, and spent 15 years at Merrill Lynch, and then in 2015 transitioned out and started my own firm as a fiduciary, as an RIA. And that really was the motivation for kind of starting my own firm, which was to really be able to do more for clients. I grew up a little bit in the healthcare industry and worked for a large pharmaceutical back in the 90s. And one of the challenges we had as medicine was being prescribed is like half the people stopped taking it in the first 60, 90 days. And so we branded this circle of care approach, if you will, in wealth management. And the goal was to make people more compliant, if you will, to following the playbook of, optimal financial planning, optimal investing. And so, I got into the business because I saw the opportunity of the gap between really good and bad financial planning. And starting our own firm, it allowed us to dive deeper into insurance planning, more property and casualty insurance, as well as just, owning the risk as a fiduciary and being able to offer, I think, more choices for clients. So that's why we started One Charles Private Wealth.
Yeah, you hit on something there in terms of investing through the cycle, in the sense that a lot of people do the wrong thing at exactly the wrong time. They buy at the highs and then they panic and sell at the lows. So this is not one of our 7 questions, but I'm just curious, how you deal with that type of psychology, which often leads people in the wrong direction.
Yeah, that's a good question. I mean, we're in the business of behavioral finance, and as Mr. Buffett said, buy fear, sell greed. And, it's a hard thing to do when emotions get in the way. So, we try to spend a lot of time on the front end interviewing clients to make sure it's a good fit. It's truly a partnership between us and our clients. And, we want to, we let people know that we're going to have good times and bad. And that, we really try to segment the money for, short-term risk, mid-term risk, and then kind of opportunistic, if you will, longer-term risk. And I think if people can identify with that, they know they'll always have enough to get through the tougher times. So it's really coaching people up and making sure that it's a good fit, and that, we try to tell people the further you are away from your money, probably the better off you are. It's easier said than done, obviously, but that's kind of the process at the beginning, is to make sure it's a good fit.
We talked offline about how being a good wealth advisor often means being a friend, a coach, and somewhat of a psychologist in a way. But what are the other things that make up a good wealth advisor and that provide differentiation?
Well, if I had to think about what differentiates optimal, not optimal advisor, I would tell you, people that have a passion, no matter what business you're in, I think works better if you can find people that like what they do, that can demonstrate a high level of curiosity and constantly looking for opportunities, whether it's mispriced assets or different solutions from a tax standpoint. So it's continuously just searching for solutions for your clients. I would say that, as it plays out, there are different tools that we can use that create some illiquidity for clients, which they're hopefully, we want to make sure they're comfortable with. But if they can't touch things for 1, 2, or 3 years, that adds a little bit of stability, so that money's not coming in and out during distressed times. So that's intentional. We tell them that it's not underhanded at all, but just really try to, I think, we'll get into this a little bit more, but that's one of the benefits of alternative investments is it's just a little more patient capital than maybe the S&P 500 or traditional equities.
Do you find that a lot of clients are impatient?
Yeah, I think, really where you have more success is what on the front end when you detail what the level of return needs to be. So we assign them a number based on the objectives that they've laid out for us. And so, it might be, hey, your number's an annualized rate of return of 6%, figuring in the wedding, figuring in the college, figuring in, the addition on the home or a second home. And so, if we manage to their number and we continue to achieve that number, then, even when you have a challenging year like last year, coming off of 3 or 4 good ones, you can show them that everything is okay. So, the comfort and clarity comes from the data, and, you have to do the work to make sure people are understanding of what the goal is here. And I think the more understanding there is, the less likely they are to interfere with the big plan.
I know you guys do a lot of customization for each client, because that's really the key, is to meet each client's unique needs. But in general, are there core investment principles that you abide by for almost all clients?
Yeah, I mean, you never ever want to be overweighted in any particular investment. And, I'm pretty matter of fact about it when we're interviewing people. I mean, this is a tough business. If you get it right 50% of the time, you're pretty good at it. So, we're pretty humble. We've certainly gotten it wrong in the past, but, you want to, the wins you have should outweigh the losses, and you want to be measured with every investment you make, so that if something does go wrong, it's not detrimental to somebody's plan that we're managing to. So I think the importance of, weighting investments appropriately, rebalancing, staying away from concentrated situations, I think is imperative.
What keeps you up at night?
I think there's a lot of good ideas that come across your desk. So, making sure we follow the process, the due diligence, getting buy-in from our custodian, from our investment committee, from the vendors that we work with on what's appropriate. But, even when you identify a good idea, it really comes down to execution. And this business is about execution. Did you get the trade-off? Did you get it off at the right price? Is it weighted properly? Did you get the right CUSIP from Fidelity? Did you have the right capital call? Did the capital call go to, a bank that might be in distress situation? So you need to just dot I's and cross T's. So I think we spend a lot of time thinking about the dotting I's and crossing T's and execution, because there are a lot of moving pieces that I think the retail investor probably doesn't even think about. So that's probably keeps us up the most, is just delivering what we say we're going to do.
Yeah, I agree with you on that. Execution, it is not seen by most, but it's probably the most time consuming, certainly. And there's so many things that can go wrong in the many processes that we're running each day, right? And there's so much reliance on outside vendors to a large degree as well. I mean, nobody's an island. I mean, we're all interconnected. So many other service providers and people that we have to rely on them. And you and I have talked offline about how frustrating it can be when vendors or others that you rely on let you down. But we can't do everybody's job for them, certainly.
No, but we own the responsibility, and conversations we've had, like, we're really not in a position to make excuses. We just need to make sure it gets done right. So, it can be frustrating, but it's also in your circle of influence eventually if you're persistent about staying on top of people. So,
yeah, I think that's one of the ways that, from what I've seen, where wealth managers and RAs can really differentiate themselves is through really strong execution, great planning on the front end, like you said, customized solutions, and also having access to interesting alternative investments that their peers might not have. And so I wanted to turn to that now in terms of alternative investments. I know you've been a thought leader in the RIA space, certainly, and not just a thought leader, but somebody who's actioned a lot of really good ideas in alt. And so I wanted to get your sense for how you think about alternative investments broadly for high net worth and ultra high net worth, and kind of how it fits into the portfolio construction process.
Yeah, I think, what we focus on when it comes to alternatives is just keeping it simple, and talking to people so it's understandable, not in the typical, jargon that a lot of financial advisors use or the industry uses. One of the things that we could do as a fiduciary here at One Charles, which we couldn't do, at a wirehouse when I was back in that environment, was buy Bitcoin for people. And so we did that back in at the beginning of 2016. And it's, there's a lot there, but if you really keep it simple, it's a supply demand thing. And, you've seen the amount of monetary easing that's gone on during COVID, and a lot of dollars have been printed, and now we're seeing inflation. And if you just understood the monetary policy of Bitcoin and explain it in simple terms to people like that, then I think they tend to get it. So we did take a 2% position across Bitcoin as kind of a hedge against what's actually playing out right now. I think no matter what you do, we do stuff with professional sports teams through a manager of ours. And, I tell you, the top 100 TV shows, 92 of them are live sporting events. And that's easy for a retail client to understand. It's actually been easier to explain ARI and what they do lately, given what's gone on with SVB. And, we tried to oversimplify that. Like, why would somebody pay 15% for money? And when you tell them, like, they're only lending it to companies that are growing at 80, 90, or 100%, they tend to understand why, that's a better mechanism to fund growth than maybe diluting the company at valuations that might be distressed given what's going on with tech. So it's really about keeping it simple. But that's the fun part of this business is I have some very smart people that are way smarter than me. And they say, I don't even need a financial advisor except for one reason. And that's because the access that you get to some of these investments and the opportunity that, and how you and I met a couple of years ago and how we got to know each other, and the dance, the due diligence, the asking of questions, getting comfortable with one another. I mean, that's the intimacy that we have with our managers. We don't have to guess what's going on. We can pick up the phone, and I know if I call you, you pick it up in 2 rings. And, I think that's what our clients hire us for, is access to great advisors, having abundant of communication and transparency and clarity. And I just think there's a great opportunity set out there to increase the likelihood of success for our clients by working in that alternative investment space.
I think you nailed it in terms of just the relationship formation that occurs and how that takes years in most cases. And I think a lot of people can miss that, and they don't realize how much work goes into this before the actual investment decision is made. And certainly at One Charles, it's not that you're seeing that shiny object and investing in it. You're thinking about it thoughtfully and building that tight relationship with the managers, which I think, totally differentiates you from a lot of RIAs that maybe are just going with the generic kind of hot thing. One thing we've talked about is just the need to provide that access to alternative investments, because the 60-40 portfolio, although it's going to be the core of most people's portfolios and rightfully should be, there's so many other attractive investments out there. And you name some of them. I mean, you got into Bitcoin well before everybody else. I think you probably made like a 30x return on your investment. So even if there is some volatility at today's prices, you're still up 30x. I mean, that's unbelievable. And, with the access to sports franchises and venture debt, you're definitely doing things I think that most others aren't, and your clients are seeing the benefits from that. I was going to ask you what you think about venture debt, but you kind of already answered that question. Just for our listeners, just briefly, what's happened in venture debt is that Silicon Valley Bank, who was the largest provider of venture debt, failed, as most people know, and that's created a big gap in the funding universe. And so essentially there's a lot more demand for capital from startups than there is available supply. So if you think about economics 101, when you have a lot more demand for something than there is supply, that creates an opportunity. So it's created a great opportunity for all non-bank venture lenders. And ARI is excited to be positioned to help out the startup community at this time and going forward. So Paul, I wanted to ask you two more questions. So one is, what's something you're thinking about on the investment side that you think most of the market is missing and is not thinking about?
Yeah, I mean, I think there's still a rational exuberance here. I saw something this morning where in February, tax collections in California were down 50%. In March, they were down 80%, right? California is usually a leading indicator on earnings and what's going to happen. So you would expect, some of the other states to start reporting a reduction in tax collections. And I don't think that's become prevalent yet, but down 50, down 80, that's a big number. So that's going to show up in S&P, 500 earnings. I don't think people are talking enough about, they're using valuations based on a number today that probably could go down 10 or 15 or 20%. And maybe you have multiple compression on that. And, I think when we were in, I don't know, was it COVID or 08? I think we got as low as 9 or 10 on the S&P as a multiple. And, I think we're at 17. So there's a chance we could go down here. So we are playing defense here. Again, it's execution, making sure everybody's kind of prepared for that environment. And so I think, people should be a little more cautious here. I think it's going to be an interesting 18 to 24 months. And I think you made a good point on the 60-40 traditional portfolio. And I have a good friend in Tucson that we talk every day about the markets, and he's a savant on the markets. And I think the average rate of return on a 60-40 portfolio was about 5% the last 20 years, and you can almost get that in a treasury today. So as a financial advisor, if you're going to be relevant, you better have a high level of curiosity and be searching out venture debt ideas or sports teams ideas, or even a little bit of Bitcoin. But, I think you hit the nail on the head. If you look at it from basic economics, supply and demand, there's way more demand than there is supply for venture debt. There's going to be way more demand for Bitcoin than there is supply, because we know it's a finite amount of tokens that will ever be mined. And I think there's only 32 NFL franchises. There's only X amount of NBA teams. Like, it's just keep it that simple, supply demand. So, that's, I think how you have to think about it.
You nailed it. It's as simple as that. It's just supply and demand, and then execution. And if you get those right, you're going to deliver pretty solid results through all types of cycles. So last question for you is, in terms of themes going forward, you already touched on some, but is there anything that we should be thinking about broadly on the investing side over the next couple of years? One that I'm thinking about is the move into alternatives from RAs. You're a leader in that, obviously, but others are going to follow. But what other themes are you thinking about in terms of kind of big picture?
Yeah, the difficulty about using alternatives, and I'm not poo-pooing it, is that, we have divorce, we deal with death, we deal with weddings, we deal with taxes, and a lot of the big institutions don't have the same challenge. So we do have a fair amount of traditional investments that we have to make on behalf of clients that maybe won't have the same liquidity restrictions. But, I think themes for us going forward is energy. I mean, no matter what you read, there's just not enough supply. Demand will continue to go up even with, excuse me for that. Demand will continue to go up, given, the world getting bigger and more economies coming online. And so that's a theme. I think whenever it's going to electrify the world, so copper, aluminum, cobalt, so playing, having a bent towards commodities with some gold, I think is increasingly important. I think, to the same reason we're talking about venture debt, I think there's still opportunities around private credit. I think that, I think managers can be very selective on who they lend money to. And so we've done a lot with some CLOs that have worked out great. And so I just think you have to be very intentional, very cautious. We're a singles and double shop. I mean, Bitcoin was obviously a home run for us, but it was weighted. It was a small part of somebody's portfolio, but we're just trying to hit singles and doubles. But those are some of the themes that we're thinking about right now.
And just today, you mentioned 5 or 6 different alternatives that are all, in my view, going to perform pretty well. And I almost never hear other RIAs talking about any of those, to be honest. So it's definitely a point of differentiation for you, certainly, and for One Charles. So, it's been great having you on today. I always learn something when I talk to you, and really appreciate your time. And for anybody that wants to get in touch with Paul and learn more about One Charles Private Wealth, you can find him on LinkedIn, on the internet, of course. And you spend a lot of time down in Florida too, if I'm not mistaken. You guys
I do. We have an office down in North Fort Lauderdale, so we're down there as well. We have a national footprint. We have as many clients out west and in New York and in Florida as we do here in Massachusetts. So we get around a little bit. So yeah, we're hungry, we're motivated, and we're detail oriented, and would always appreciate the opportunity to give somebody a second opinion. So really appreciate you having us on today, and keep doing what you're doing, Zach. It's afforded us a lot of new clients, frankly, by having access to this kind of manager. So thank you.
Thanks for coming on, and thanks everybody for listening to the 7 and 7 show with Zach Ellison and our guest today, Paul Squarcia. See you next time.
Have a good day.